What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 12th of 2019. Well, folks, I hope you all are having a great day wherever you are, and today I want to spend a little bit of time, as I do from time to time here on the DataDash channel, to go through some very important indicators and key data sets that will help paint a clear picture as to what's to uncover in global markets going into 2019. Now, as you all know, at heart, I'm a macro trader. I love doing this kind of stuff. I love getting a big picture view and really going through all the data I have to work with to kind of get a rough prediction as to where we could be looking at things heading in the next few months or year. And as a trader and investor, I tend not to just get caught up simply on surface level things. I think it's a big mistake that a lot of people make. A lot of people just focus on current price action and maybe do a little bit of technical analysis. But as much as that can give us a little bit of perspective as to where things are going, we need to understand the fundamental data sets and indicators that really will make markets go higher or lower over time when we're talking about equity markets and the housing market and other different types of assets across the board. And really, it's not that complicated. There's a few key indicators that really matter. And today, we're going to be talking about two of those major indicators, as well as a few other important things that kind of come in combination with that and some important things we should keep an eye on. So I rambled on enough. Let's go ahead and dive into it, guys. The first thing I want to talk about is balance sheets. Now, one big mistake that I see a lot of people make, and it's an honest mistake, I used to do it myself when I was trading and investing, is that I get caught up in a little bit of a bubble sometimes, or I used to get caught up in this bubble where I would just simply think, when I thought about central banks, I simply thought about the Federal Reserve, right? And it makes sense. If you're in the United States, the majority of you who watch my channel are in the US, a lot of people get caught up thinking about the Federal Reserve and the Federal Reserve's monetary policy. But as much as the balance sheet that the Fed has, for example, to simplify what the balance sheet is, I think that would be a good place to start. The balance sheet is basically what the Fed has on its books in regards to mortgage-backed securities, U.S. Treasuries, things that basically are assets that they've stockpiled over the past years to help stimulate the economy. And this is how the Fed actually helped. It was one of the major two things that the Fed used during 2008 by basically propping up the market in a time where there was fear and panic by buying off the bad mortgage-backed securities from banks, buying U.S. Treasuries, things of that sort, to help stimulate the economy, to put cash into the economy in that case, and taking off a lot of the bad decisions from banks and putting it onto the Fed's balance sheet. Well, now they're starting to offload that. But it's not just that we need to keep an eye on. In fact, it's much more important when we're talking about global markets to not just focus on the U.S. central bank, but the central bank's balance sheets of all central banks in the world. And there's a lot of extra data we have to work with here. And it's a very important thing to keep an eye on because it shows where global trends are. When we start to compound the balance sheets of all these banks, we get a very clear picture as to where central banks are either, for example, going through quantitative easing, which is what we've seen over the past decade, or starting to step into what is known as quantitative tightening, where they're starting to reduce their balance sheets. They're starting to dump assets onto the open market, those mortgage-backed securities, the U.S. Treasuries, things of that sort. Well, take a look at this data set here, guys. This is very interesting. Now, the last data point we have to work with here is from August in 2018. So we're still waiting for some of the newer information to come in, but this is one of the best sources to paint that picture of what I just discussed. A global central bank balance sheet. And take a look at the trend right now. Over the past few years, we've not only seen a general rise in central bank balance sheets since the early 2000s, but really since 2008 with the spike up in the Federal Reserve and the ECB in this case, we started to see a major rise in global bank central bank balance sheets. But here in 2018, that all started to change. If you guys watch my channel, you've heard me talk about how in 2018, I was starting to turn bearish on markets. And there's a specific reason for that. It has to do with this key index right here. Now, I didn't see it at the time. I've watched this chart before. Data sets like this from PIMCO have been around for a while. But the thing is that I heard from Janet Yellen, who was the Fed chairman back a few years ago, and a continued message from Powell that we would see a continued reduction from the Fed's balance sheet. And you started to hear this message from a variety of different central banks. You started to hear from the ECB that they'd stop adding assets to the balance sheet, that if anything, they were going to start working to reduce it. So when you start to hear these policy shifts coming in clearly, we know that this has been a major boost to the economy, right? I mean, since 2008, we've gone from around $10 trillion in central bank assets, or assets being on the balance sheet of the central banks, all the way up to 25 trillion. That's more than a 100-fold increase. That's a 150% increase in this case for central bank balance sheets. So That's a worrying sign in this case we need to factor into play here. And when we start to see that reduced, it shows that we are now seeing a sell side pressure, right? The central banks, think of central banks as an investor in this case, right? They have all these assets and they've been buying it for years and years, guaranteeing, hey, look, investors, you might as well buy equities and prop up the market because we're going to be buying these things. We're going to be buying these bad assets. We're going to be buying treasuries. We're going to be buying all types of different things. In many cases, it's important to understand as well, some of these larger ones like this dark blue one, like the Bank of Japan, they've been a major repurchaser of Japanese ETFs. They owned, back a few months ago, I think 80% of all Japanese ETFs. Think about that. A false a sense of buying pressure has been propping up equities across the world. And that's really what's known as these central banks, right? So again, as we started to see this trend reversal, it is very important to realize that trillions of dollars, in this case, of sell-side action is starting to come onto the books of equities. This provides downward price action or downward pressure. And along with this as well, we have to talk about the second factor here. It's, again, not just the Federal Reserve here in this case. The second thing we have to talk about is interest rates. Now, again, because the U.S. economy plays such a large role, and because most of us live in the United States who watch this channel, we tend to hear talk about the Federal Reserve raising interest rates. And they have been pretty forward going in this. They have been pretty confident that by this year, or at least Powell, the Fed chairman, has been confident that we're going to see 3% this year, if not even higher, maybe 3.5%, things of that sort. And there's all types of different prediction markets, but more than anything, we're getting to ranges where people have gotten concerned about interest rates being too high. The scary thing is that it's not just the United States. More than half of global central banks in their last rate decision period have actually hiked. They have not decreased. So this is very concerning. We either have central banks stagnating, where they're keeping rates at the current levels they're at, or they're continuing to increase them, which starts to set, rather than quantitative easing, quantitative tightening on the economy. So there's a really nice graph here in this Market Watch article that I'll go ahead and zoom in on. And if you can't see it very clearly, I think you guys should be able to read it fine. But basically, this is an index right here, the MSCI All Countries World Index, which takes into account global equity valuations across the world, right? We can see we're already generally around the range we were at in 1998. Again, it's a logarithmic chart, which is important to note here. It looks logarithmic in that case, but I might be wrong. Either way, we can see, generally speaking, that we're around that range where we started to see pullbacks in equities. But another thing as well, this is really the key data point to focus on, is that this is a percentage of central banks that are whose last rate change was a decrease in this case. So we can see that most central banks are not decreasing, they're increasing in this case. It's pretty much a flip on the index, a play on the words. So basically, we are now in 2018 seeing more central banks tightening. Now, it's important to understand what central banks are doing this. The biggest one is obviously the United States, but there are talks as well, as we start to see this declining trend, that the European Central Bank, or the ECB, is going to have to probably follow suit with these moves, as well as a lot of other Western economies, because the issue right now is that as the United States aggressively raises interest rates, there is a major competition on the global stage. There's a reason Fed Chairman Powell is so quick to move on this. That's a very pleasant photo of him, but there's a reason he's doing this. It's because, and this is something, again, we have to understand, that not all bankers around the world are best friends. They do cooperate in unified systems under the Bank of International Settlements and the IMF and these kind of banking organizations that set standards and rules. But the U.S. wants to stay competitive. And what Powell's doing in this case, even though it is knocking down valuations of equities, he's trying to build a strong dollar, because with higher interest rates, we tend to find higher valuations in currency. And we're also getting a sweet spot here, because in the United States, like most economies, we're actually, at least on the surface data, I would say that it's maybe a little bit higher than reported, but on the surface data, we're not seeing crazy rampant inflation like we were seeing possibly in the early 2000s, right? So that's a perfect combination for a currency to rise in value. And if you take a look at the DXY or DXY, you can see that the dollar index has been increasing comparative to other currencies. So DXY is a combination of the US dollar comparative to a variety of other currencies. It's a ratio index, and you can see that the US dollar has been rising on average over the past year. And again, this has to do with Fed monetary policy. And with a stronger dollar, you have more purchasing power on the global stage. A 5% leap up and the dollar index could mean massive purchasing power increases for the United States. So again, just trying to kind of explain that in this case. nonetheless, I went on a little bit of a tangent, but the thing is, the other central banks are pressured because of this. They have to try and raise interest rates. It may be terrible for their economy. It may be that this quantitative easing, where they provided low or near zero interest rates for the past few years, like the United States did, was what allowed so many failing businesses who originally otherwise wouldn't be profitable if they needed to borrow capital to borrow capital. And in some economies, like in Japan, we started to see negative interest rates, where basically people could actually borrow capital and get paid to borrow capital, right? To take risk that may not even produce a profit, right? So you see that kind of craziness there in that sense. It's important to understand this here and just how far we've gone. And now we're starting to dig ourselves out of the tunnel. What happens when we actually start to underlie the economy with real interest rates and without the quantitative easing? In fact, quantitative tightening of the balance sheets on the global stage. And this is coming at a time, guys, where we're at 184 trillion. Again, I think the number's a little bit higher, depends on what debt we're talking about, but general well-known debt of mortgage debt, credit card debt, government debt, things of that sort, has reached $184 trillion. And the United States owns 11.4% of that, just as a decent picture to get an understanding. So I'm not so much focusing on the United States. I know a lot of people think that the United States is either in a really strong position or a weak position compared to the global economy. I think it's a topic for another time. What we can see is that we've got a major debt burden. And as interest rates rise, the interest payments on that debt go up on average. So this is a little bit concerning. If we continue to see going into 2019, this debt bubble starting to continue to build and interest rates increasing, the effect of that debt becomes even larger in that case because the interest payments on it are going up. And it sets a precedent for the economy. It sets more restriction on everyday consumers that are already being crippled by debt, with a student loan bubble that's over $1 trillion, with credit card debt reaching peak levels passing 2008. Over $1 trillion, mortgage debt back up to levels it was back in 2008. I mean, it seems like we're repeating history here, folks. And central banks, as they have to, because of the mechanics of money, they have to compete to keep the purchasing power of their currency. That's the base level of importance for an economy. And they're doing that through raising interest rates, which again sets more restrictions on borrowing capital. It makes it more expensive, which again repeats the same boom and bust cycle we go through historically. So now that we've talked about this, again, I mentioned again the highest credit card debt in U.S. history back in, this was actually back in 2017, but we've actually gone higher in 2018. Of course, as the economy has increased, people take more credit out and interest rates have been rising. So it's not a good correlation in that case. So what am I looking forward to, guys? Well, I know it's not really popular right now because markets are down, and I definitely feel, I think a lot of people have lost confidence in it, but I'm still focusing on the two markets that I've talked about beforehand. I'm very excited about where cryptocurrencies are going in 2019. I don't think it's going to be extremely wild just yet. I think we're going to see more of the justification with a mixing, how would I put it? I would say mixed ideology as to where markets are going in 2019, 2020. We'll start to see a little bit more on the fear side going into, we'll see things go more towards the fear side in 2020. And because of that, I think cryptocurrencies will start to follow as a potential hedge on global currencies, specifically more than anything, not for the US dollar, not for a lot of the major world reserve currencies like the euro or anything like that. I think more than anything for emerging market currencies. But there's a big market for that. Again, I think we live in a bubble sometimes. The United States and Europe and even China and India, well, actually I'd say we want to include those because China and India could be potential candidates through 2020 that start to see some very serious devaluation of their currencies. The Indian rupee as well as the Chinese yuan have been in bad positions. But I'm not so much, again, talking about the US dollar and the euro. I think those are going to come later, into the later 20s. But nonetheless, huge market of currency valuation where cryptocurrency could step in and take some of that value and really start to actually build some fundamental value long term rather than just simply being speculative in this case. And along with that, gold and silver. Guys, look, I'm no precious metal bug. You don't see me, with gold and silver bars in the background. I'm not talking about it 24/7, but I will tell you all that gold and silver right now is actually quite attractive. And it's, again, for the two reasons I mentioned, the worries in emerging markets, but also the pullback in equities that we're going to see over the next year. And with that, people looking for an out. They're trying to put their money somewhere. They want to make sure that they either maintain the purchasing power and or hopefully gain in periods of speculation where there's emotions in markets. And we're starting to reach that period, especially as equities start to decline. So gold and silver definitely on my eyes as well. Those are really the two markets that I'm watching, precious metals and crypto right now. I think there's also a lot of interesting trades in currency markets, but more than anything, it's a matter of watching not only interest rate policies, as we talked about, but also keeping an eye on what central banks are able to sustain quantitative tightening to different degrees. That's really where I think you'd see the competitive trades in that case. But again, in summary, we can see where, this is the Vanguard's total stock market ETF. We're back towards levels in 2017 for this ETF. This is a good index of most of the U.S. equities. And we can see as well, central banks are starting to roll off the balance sheet, right? Interest rates are starting to rise. It makes clear sense, folks. When interest rates are starting to rise to levels that are almost twice as much as they were back a year or two ago in the United States, when you have assets getting rolled off the balance sheet, it is not rocket science. The economy is going to tighten. That's why they call it quantitative tightening. And it is going to lead to a slowdown, not only in equities, but overall global economies. So again, not here to say that we're going through yet another 2008. I don't know if we're going to be in that sharp of a correction. If things continue to persist, possibly. But more than anything, we're stepping into a recession. It's very clear, guys. It's time. It's overdue. You can take a good look here at where we are on the global picture of prices. This is back in 2006 to 2008. It's not too difficult. So again, that's it for the video, everyone. Thank you all so much for watching. I hope you all enjoyed this. I hope I didn't ramble on too much, and hopefully pointed out some really interesting data and charts that you guys will admire and enjoy, and maybe will help improve your analysis of macro markets. I hope I encourage you to become a macro trader by now. I know I talk about it a lot on the channel, but it's a very fun job in a sense, or hobby to take on, because it's very cool to see where opportunity lies. There's a lot of opportunity in the world stage, and you can bet for markets, you can go long, but you can also go short. You can bet against markets. So know that there's opportunities nowadays to do all kinds of things, and not to miss out on those opportunities when they're right there in front of you if you just look at the data set. Anyways, that's it for the video. Thank you all so much for watching, and I hope you all have a wonderful rest of the day. Take care.